Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Chris Bystrom of Ruca. Chris, thank you for joining us.
Yeah, thanks for having me.
So what was your background before investing in early stage companies?
Yeah, so I kind of got into all this world through running design firms, UX design firms. So I've run design firms in Chicago, Tokyo, and New York. So before kind of getting into the early stage investing, I was building lots of large enterprise grade software for lots of clients in kind of a design services sector, and then ran one of my own startups for 2 years. And then saw what was good about the space, what was bad about the space, and wanted to create a kind of different model, which Ruca is. That's more of a founder support system for early stage capital and advisory.
Well, great. So you've been investing in early stage for a while. What's your advice for people that are starting to invest in that stage now?
You see a lot of different things in the early stage, and there's really there's no right way, there's no wrong way to do it. I think it all comes down to the teams. We've seen teams that I think the biggest thing from advice would be to really focus in on a personal problem potentially that you have, and because you'll have a lot more of the willpower to kind of see it through the valleys and through the ups and the downs through that. And then I think it's an interesting space, and really there's no bad idea at the beginning. There's a lot of bad execution, but I think be able to move on from an idea. The most things that I've seen in the early stages, people get too attached to, myself included with the previous startup, too attached with one single idea and aren't willing to kind of evolve that or see that and test that out, and have a lot of basically we train our startups to basically look at everything as like a hypothesis, right? And it's just like a big research project for the first 6 months, and you're debunking hypotheses and you're doubling down on things that are working well.
Sounds like a great vetting process there.
Yeah.
So how is the industry evolving for early stage investing? What changes are you seeing out there?
A lot of funds are going a lot further down the line, right? I think a lot of things because of how stuff went over the last, I would say, 10 to 20 years. There's a lot more needing to show traction. So things are being kind of bifurcated out in different ways, where I think it used to be more where there's kind of founders of companies had exits, whether those be $10 million exits, $100 million exits. A lot of the capital is being kind of held longer, which isn't kind of then going back down into the early stage investing as much as it used to be. And I think what's happened now is you see a lot of more traditional investors and stuff putting together funds and having people kind of run those funds that might not have started companies in the past. So I think that there's a lot more just kind of spreadsheet type of investment going on in early stage capital. I think that where it needs to go is more back towards people who have started companies, especially for the early stages, because there's just so many different things that you can't write down. As much more like a learned behavior than it is something that you could read about.
You see a lot of micro VCs out there now, $25, $50 million funds run by a wide range of investors that created kind of a different dynamic in there, although they fill a key part of the process because most of the venture funding moves to later stage and trying to get bigger funds and further down the line. So I see that a lot myself. Is that what you see?
Can you repeat the first part of that?
What I see is a lot of micro VC funds coming in where they have $25 to $50 million funds. And so there's a lot more investors to raise funding from, but those tend to be smaller checks than standard VCs. But standard VCs seem to have moved to being bigger funds and at a later stage in the process.
Yeah, I think standard VCs, if you were good at what you were doing over the last 20 years, a lot of them have definitely moved to bigger checks. That's a little bit more de-risked at the very front, because the riskiest is always going to be that first 16 to 24 months of getting things up, because there's going to be every failure or every wasted month of effort that doesn't see any return on that can be felt a lot more. So I think that a lot of them are moving upstream, and then I think you have a lot of these micro VCs, but a lot of the micro VCs are specifically started around a certain hypothesis, right? With specific LPs behind those, right? They want to invest in XYZ, right? Or they want to invest in blockchain. So it's only going to be blockchain. Or they want to invest in the cannabis industry, and it's specifically cannabis, right? So I think that is an interesting kind of evolvement with all of the things going on. And I think from a trend perspective with the early stage, if you put the time in to build kind of the network around a venture before diving straight in and just needing the capital, you can do a lot of things a lot cheaper than you could 10 years ago, 20 years ago. And you can test out things without having to do traditional raising. It's just cheaper to build out MVPs now than it ever has been.
So for your fund at Ruca, what is your investment thesis for that fund?
Yeah, so our investment thesis, so we don't have any LPs. We have a very interesting model, we think, which is more based on a one-to-one type of model. So we have a services side business that works with large companies like Forbes, like IBM, like lots of large enterprise Fortune 100 companies. And then from the margin and the revenue that we generate from doing product service for that, we cut that into a fund. And so by doing that, we have no LPs and we have no traditional investment thesis. Although we do like to invest in things that we would consider kind of art, culture, societal, and kind of the things that we break it down to is really comes down to four things. Are these good people wanting to do it for the right reasons? Is it a personal problem to them? Does it have the potential to positively improve society? And can our collective skill sets and networks and backgrounds be an unfair advantage to them when they're building their company? Because Ruca is it's a global design co-op of about 50 people now with 7 venture partners that kind of run the different things. So we try to find those diamonds in the roughs that traditional VCs would stay away from, right? Because we invest and take equity, small portions of equity, to kind of be a founder support system for them over the first 2 years of building it, helping them with brand and product and everything. So,
are there a couple of startup examples you can point to that fit that thesis?
Yeah, so a couple of ones we got involved in last year. We usually do about 2 deals a year, right? Because we actually invest our time and capital, right? So we try not to spread ourselves too thin. So from last year, we got involved with a company called Artivist, which was like an art tracking software, which was interesting. And then our 2 kind of bigger ones from last year, one of which is a company called Bright, which has a lot of good investors behind them right now. And it's kind of a headspace meets Talkspace for parenting. And they're doing good, and they just raised some more capital now. And we met them through, it's the ex-CTO of Guilt Group, so heavily connected here in New York. Good guys. And then the other one, and he was solving a personal problem. So kind of they were our first investment, and that kind of helped us mold our own model. We were kind of like our first fund was called Grind. We were grinding up our first kind of VC fund at the same time with our startups to kind of evolve it like a product towards them and what they needed. The second one we got involved with last year is a company called With Friends, which has a really cool kind of membership platform for cultural spaces and has a huge, vibrant community around them in Brooklyn in New York. And we kind of helped them more on like the business modeling side and then help build a better product around what they had, which was a very active community and revenue. And they got into YC, and they just came out of YC's latest batch. So they're upward and onward.
That sounds great. So you talked about the cost of MVPs going way down, so what are the challenges you see startups having to overcome to be successful at the early stage today?
Yeah, I think if anything, it's time. It's always time. Like the time to commit into the venture, right? Like I live in New York. A lot of my fellow colleagues and stuff live in New York or San Francisco or expensive cities, right? So I think that creates an just added pressure of being able to make ends meet. So I think one of the things is definitely time and capital, like it always is. But then I think there's also just kind of there's a lot of not bad advice out there, but there's a lot of people that have specific reasons of why you should do X, Y, Z, and it's all kind of a path that you're going to have to go down to. So some of the decisions that you make early on in your startup have long-lasting consequences, not just from a capital perspective, but there's how you build your company. And that goes back to there's no right or wrong way. It's just there's tons of variables, and that can be very overwhelming at the very beginning when you have 100 different variables that can combine in lots of different ways. Like, how do you put those in the right line? Because there's probably only a few solutions to those original questions which lead you in the right direction at the beginning. So that can be a daunting task, and having the right people and advice around you to do that are really in it for your best interests at heart. That can be hard to know that, right? Because you're trying to move fast. It's it's kind of the push and the pull of trying to move fast but thoughtful, right? And that can be very hard.
It's a tough trade-off to make between the two. So there's a lot of sectors and applications out there in the market today. Do you see which 2 or 3 would you point out as being really good ones to pursue in this time frame?
I think full disclosure, I used to have a political tech startup, right? So I think things that our government moves slow on are things that have a lot of value potentially and a lot of acquisition value potentially, because you'll always be able to move faster usually. So I think for me, I would say if I was going to start a company tomorrow, it would be in the education, like ed tech space. We really like everything around what's going on with like pets and vets, right? So like pet tech, vet tech, whatever you want, vet tech, whatever you want, whatever they brand it. I think there's a lot of interesting stuff that's going on in that sector because people love their animals, and people are having kids later, and there's just a lot of money in there, and it's just an interesting space that you can build a company based on like love towards your pets, which would definitely have a high user stickiness. So yeah, I think ed tech, vet tech, and I think there's always a lot of stuff to do in gov tech, but those can be long sales cycles.
Yeah, those sound like good opportunities that have a lot of staying power as well. So in the last few minutes that we have here, what else should we cover that we haven't?
No, I think we've covered everything. I think one thing that like we try to push on, I think that is an interesting thing for us from like a co-op perspective, is there's just so many different models and kind of like gig economies out there today that you can tap into to build companies at much cheaper initial cost until you've proven out like a product market fit. And then after that, then you have to prove out a revenue that somebody actually pay for it. It's like kind of follows those same things. But I think that's kind of like the biggest thing to look at is like, what are all those options? What are those implications from accelerators to going down the VC path, to going down an angel friends and family path, to everything in between.
That's true. So how best for listeners to get back in touch with you?
Yeah, so you can go to our websites at ruca.co, ruca.co. And yeah, there's a way to reach out on there. And yeah, and that goes for people, designers, the hipster hackers, hustlers of the world that are looking to do services work and be a part of like a global co-op, and then people that are looking to build up pre-seed early stage companies.
That's great. We'll put that in the show notes, and thank you for taking time today, and hope to have you back for a follow-up soon.
All right. Thank you so much.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.